Welcome to Stage 3 of the Financial Literacy Mastery series. In this part, we move from basic investing to strategic wealth building, focusing on advanced concepts that transform you from a simple investor into a strategic wealth builder. This stage is designed for serious learners who want to understand not just what to invest in, but how to construct a portfolio, manage risk, and protect wealth over decades. You'll cover asset allocation, behavioral finance, market cycles, advanced instruments, real estate, inflation hedging, and risk management. By the end, you'll have a comprehensive framework for building and safeguarding wealth. This web series is structured in 4 stages. Stage 1 covers financial foundations, Stage 2 dives into core investment tools, Stage 3, where you are now, focuses on strategic wealth building, and Stage 4 will guide you to financial independence. Each stage builds on the last, deepening your understanding and skills. At level 8, you're learning to think beyond products and start seeing your financial life as a system. This progression is essential for anyone aiming to achieve lasting financial security and independence. Asset allocation is the most critical decision for any investor. Research shows that it determines 80–90% of your long-term portfolio returns, far outweighing stock picking or market timing. By thoughtfully distributing your capital across different asset classes, such as equity, debt, gold, real estate, and cash, you create a portfolio that grows steadily and withstands market downturns. Think of asset allocation as a recipe. Using multiple ingredients ensures a balanced, satisfying outcome. This concept separates serious investors from casual ones and is the foundation of strategic wealth building. Asset allocation involves deciding how to spread your investment capital among various asset classes. Each asset behaves differently in different economic conditions. By combining them, you can achieve steady growth and limit losses during tough times. For example, equities may perform well during bull markets, while debt instruments shine during recessions. Gold provides stability during inflation or geopolitical stress, and real estate offers growth during urbanization cycles. Cash is crucial during uncertainty. The right mix depends on your age, income, goals, and risk tolerance. Every asset class comes with its own risk-return trade-off. High returns usually mean higher volatility and uncertainty, while low-risk assets offer stability but limited growth. The art of asset allocation is finding the right balance for your situation. Your goal isn't to maximize returns, but to maximize risk-adjusted returns, the returns you can achieve without taking on more risk than you can handle. The best allocation is one you can stick with, even during market downturns. This principle is central to building a resilient portfolio. Understanding how each asset class behaves is essential. Equities offer high returns and liquidity but are volatile. Debt instruments provide stability and moderate returns, performing well during recessions. Gold acts as a hedge against inflation and geopolitical stress. Real estate offers growth, especially during urbanization, but is illiquid. Cash and liquid funds are safest and most liquid, ideal during crises. Each asset class has its place in a diversified portfolio, and knowing their behavior helps you make informed allocation decisions. Correlation measures how assets move relative to each other. Combining assets with low or negative correlation reduces portfolio volatility without sacrificing expected returns. For example, in 2008, equities fell sharply while gold rose, cushioning losses for diversified investors. Diversification is the mathematical foundation of risk reduction. By mixing assets that don't move together, you create a portfolio that's more stable and resilient, even during market shocks. This is why diversification is often called the only free lunch in investing. Diversification allows you to reduce risk without giving up returns. By combining assets with low correlation, you lower the overall risk of your portfolio while maintaining structural returns. Unlike other risk reduction strategies, such as holding cash or buying insurance, diversification doesn't require sacrificing returns. It's a powerful tool that keeps your portfolio intact during market turbulence. Nobel laureate Harry Markowitz famously called it the only free lunch in investing, emphasizing its unique value for investors. There's no single correct allocation, but logical frameworks exist based on investor profiles and time horizons. Aggressive investors, 25–35 years, may hold 70–80% equity, moderate investors, 35–50 years, balance equity and debt, while conservative investors, 50+ years, prioritize capital preservation with more debt and cash. These archetypes are starting points, not prescriptions. Your allocation should reflect your financial goals, income stability, time horizon, and comfort with volatility. Adjust as your circumstances change. Knowing asset classes is just the start. Building a portfolio requires designing it around your goals, structuring it to survive volatility, and keeping it simple enough to manage for decades. The most effective portfolios are built backward from goals, not forward from available products. Identify your major financial goals and their timelines, then select asset classes that best match each goal. This approach ensures your investments are purposeful and aligned with your life plans. Start by identifying your key financial goals and their timelines. For example, an emergency fund requires immediate liquidity, while retirement planning needs long-term growth. Child's education, home purchase, and wealth accumulation each have unique time horizons and asset needs. By matching asset classes to specific goals, liquid funds for emergencies, equity for long-term growth, debt for capital preservation, you build a portfolio that supports your life's milestones and adapts as your priorities evolve. Core Satellite Framework is an elegant portfolio design. The core, 70–80%, consists of stable, diversified, low-cost funds aligned with your long-term allocation, like index funds and diversified debt funds. The satellite, 20–30%, includes tactical, high-conviction positions such as sectoral themes, international funds, or gold ETFs. This approach balances discipline and flexibility, allowing you to capture market returns while selectively enhancing performance. Never let satellite positions dominate your allocation logic. Diversification is multidimensional. Most investors only diversify across asset classes, but it's equally important to diversify across industries, market capitalizations, and geographies. Within equity, spreading exposure across sectors like technology, healthcare, and consumer goods reduces sector-specific risk. Combining large-cap, mid-cap, and small-cap stocks balances stability and growth. International diversification exposes you to different economic cycles and reduces country-specific risk. Proper diversification protects your portfolio from concentrated shocks. Over time, market movements skew your portfolio away from your target allocation. If equities rise, the share may grow beyond your intended risk level. Rebalancing is the process of restoring your portfolio to its target allocation, usually by selling assets that have grown and buying those that have lagged. This systematic approach helps you sell high and buy low, maintaining discipline and managing risk. Rebalancing can be time-based or threshold-based. Consistency is key. Your ideal portfolio evolves as your life changes. Early in your career, aggressive equity allocation and disciplined SIPs are best. As income rises and liabilities grow, add debt for balance. During peak earning years, build your retirement corpus with a balanced allocation. As you approach retirement, shift toward debt and stable assets, reducing equity exposure. In retirement, prioritize income-generating assets and low volatility. Adjust your portfolio as your income, liabilities, and risk capacity change. Traditional finance assumes investors are rational, but behavioral finance reveals that humans are not. Understanding why people make poor investment decisions is crucial. Fear, greed, overconfidence, and impatience drive market movements and often cause investors to underperform even passive strategies. Recognizing and naming biases is the first step toward overcoming them. Behavioral discipline is a key pillar of strategic wealth building. Markets are shaped by human decisions. Emotional reactions, fear, greed, impatience, can lead to buying at peaks and selling during crashes. The DALBAR study shows that average investors earn much less than the market due to poor behavior, not bad products. Your own psychological responses to market events can cause you to underperform, making behavioral awareness essential for successful investing. Loss aversion is the tendency to feel losses more intensely than gains. Psychologists found that losing money is twice as painful as gaining the same amount. This drives damaging behaviors, such as selling during market corrections to avoid pain, which locks in losses and misses recoveries. Recognizing loss aversion helps you stay invested during downturns and avoid premature selling. Confirmation bias is the tendency to seek information that supports your beliefs and ignore evidence that challenges them. Investors may focus on positive news about their favorite stocks and dismiss negative analysis. The antidote is to actively seek out the strongest case against your investment thesis. If you can't identify risks, you haven't thought clearly enough. This bias can lead to poor decision-making and missed warning signs. Recency bias causes investors to overweight recent events and assume they will continue indefinitely. After a bull market, people expect markets to keep rising. After a crash, they expect continued declines. This leads to buying high and selling low, the opposite of successful investing. Recognizing recency bias helps you maintain perspective and avoid chasing trends or panicking during downturns. Herd mentality is the tendency to follow the crowd, especially when everyone is buying an asset. This behavior drives market bubbles and crashes. The most expensive words in investing are, "everyone is doing it." By the time most investors are excited, the easy gains are gone. Avoiding herd mentality requires independent analysis and discipline, even when it feels uncomfortable. The confidence bias leads investors to overestimate their ability to pick winning stocks or time markets. Studies show most people rate themselves as above average, but excessive trading and poor timing often result in worse performance. The more actively individual investors trade, the worse their results. Recognizing overconfidence helps you stay disciplined and avoid unnecessary risks. Anchoring bias occurs when investors place too much importance on a reference point, such as the price at which they bought an asset. Decisions are made relative to this anchor rather than current reality. For example, refusing to sell a stock until it returns to its purchase price, even if better opportunities exist. The rational approach is to evaluate each decision based on present information, not past anchors. Written investment framework is the most effective antidote to behavioral bias. This document defines your investment philosophy, allocation targets, rebalancing rules, and criteria for making decisions. It also includes rules for what you will not do, such as panic selling or chasing tips. When markets fall and emotions rise, your framework acts as the voice of reason, helping you stick to your plan and avoid costly mistakes. Markets move in response to economic forces and cycles. Understanding the macroeconomic landscape doesn't enable you to predict markets, but it helps you understand why markets behave as they do. Business cycles, expansion, peak, contraction, and trough, have distinct characteristics that influence market behavior and investor mood. Recognizing these patterns helps you make rational decisions and stay invested through volatility. Business cycle includes expansion, peak, contraction, recession, and trough. Each phase affects corporate earnings, market behavior, and investor mood differently. Expansion brings optimism and bull markets, peak leads to euphoria, contraction causes fear and bear markets, and trough is marked by skepticism and recovery. The best time to buy is often when despair is highest, while the worst time is during euphoria. Understanding these phases helps you avoid common mistakes. Bull markets are sustained rises of 20% or more from a market low, while bear markets are sustained declines of 20% or more from a market high. Since 1950, the US market has seen roughly equal numbers of bull and bear markets. Bear markets typically last 9–10 months, bull markets about 2.7 years. Despite downturns, the long-term trajectory is upward. The biggest risk is selling during bear markets and missing recoveries. Interest rates set by central banks are powerful forces in financial markets. Rising rates hurt bond prices and growth stocks, while falling rates boost corporate earnings and support bull markets. Understanding the interest rate cycle helps you anticipate when debt funds might outperform and when equity conditions are challenged. However, this knowledge is for context, not for market timing. Turning points are unpredictable. Inflation impacts assets differently. Equities with pricing power hold up in moderate inflation, but high inflation compresses margins. Debt loses real value in high inflation, while gold acts as a store of value. Real estate generally protects against inflation over the long term. Inflation awareness is central to portfolio strategy, ensuring your investments maintain purchasing power and build real wealth. Volatility is the price of long-term return. Equity-level returns require enduring equity-level volatility. Trying to escape every downturn means missing recoveries and destroying compounding. Missing just the 10 best trading days over 20 years can cut your returns dramatically. The best days often occur during or after the worst periods. Staying invested through volatility is the highest value decision most investors can make. Advanced instruments like derivatives are important to understand conceptually. Derivatives are contracts whose value is derived from an underlying asset, such as stocks or commodities. The most common types are futures and options. Originally designed for risk management, derivatives are often misused for speculation. For most retail investors, they are high risk and require deep expertise. Futures contract is an agreement to buy or sell an asset at a predetermined price on a future date. Originally used by farmers to lock in crop prices, futures provide certainty over speculation. For example, a wheat farmer can sell a futures contract to guarantee income regardless of market price changes. Futures are valuable for managing risk, but can be dangerous when used for speculation. Options give the buyer the right, but not the obligation, to buy or sell an asset at a specified price before a certain date. The buyer pays a premium for this right. Call options allow buying at a set price, while put options guarantee a selling price. Options provide asymmetric protection. Downside is limited to the premium paid, while upside is uncapped. They are useful for risk management, but complex for retail investors. Hedging is the legitimate use of derivatives for risk management. For example, a portfolio manager fearing a market fall might buy put options as insurance. If the market drops, the options gain value, offsetting portfolio losses. This is derivatives used as designed to manage risk, not speculate. Retail investors should approach derivatives cautiously and focus on their risk management role. Most derivatives involve leverage, the ability to control a large position with a small amount of capital. Leverage magnifies both gains and losses. Small market moves can wipe out your margin quickly. Derivatives are zero-sum, with every profit matched by a loss. Professional traders have advantages in execution and risk management. Retail investors face structural disadvantages and high risks when trading derivatives. Real estate is a dominant investment for many families, offering stability and emotional significance. However, compared to financial assets like equity mutual funds and REITs, real estate has low liquidity, high transaction costs, and requires significant management effort. Equity funds offer superior liquidity, diversification, and lower effort. IITs bridge the gap, providing commercial property exposure with stock-like liquidity and small ticket sizes. Real estate returns are often overstated because investors ignore the true costs of ownership. Stamp duty, registration, brokerage fees, annual taxes, maintenance, renovation, vacancy risk, and EMI interest all reduce actual returns. When these costs are factored in, risk-adjusted returns are lower than headline appreciation suggests. Understanding the real cost helps you make informed investment decisions. Real estate has genuine advantages in specific situations. A self-occupied home provides housing security and builds equity. Leverage can deliver attractive returns in growing areas. Commercial property in the right location offers strong rental yields. However, for most investors, a combination of equity mutual funds for growth and one primary residence works better than multiple property investments. EITs, real estate investment trusts, allow retail investors to access commercial properties with small investments. IITs are listed on stock exchanges, offer regular income through dividends, and provide liquidity and diversification. Professional management handles operational matters. India's IIT market is growing, with several listed options. IITs bridge the gap between physical real estate and financial assets, offering a balanced approach. Building wealth isn't just about growth, it's about protecting it from inflation. If your returns only match inflation, your purchasing power doesn't increase. Real return is nominal return minus inflation. Equity and gold are powerful inflation-beating assets, while savings accounts and fixed deposits often deliver near zero or negative real returns. Inflation-aware investing is fundamental to genuine wealth building. Gold has served as a store of value for thousands of years. During periods of high inflation or uncertainty, gold retains or increases purchasing power. It's not a growth asset, but a preservation asset. A well-constructed portfolio typically includes 10–15% gold for meaningful inflation protection and stability. Gold stabilizes portfolios without significantly reducing long-term returns. Sovereign gold bonds, SGBs, are government securities denominated in grams of gold. They appreciate with gold prices, pay 2.5% annual interest, and offer tax-free capital gains if held to maturity. SGBs carry no storage risk and are backed by the government. The only drawback is limited liquidity. SGBs are an efficient way for Indian investors to hold gold and benefit from both price appreciation and interest income. Beyond gold, broader commodity exposure, energy, metals, agricultural products can provide additional inflation hedging. However, direct commodity investment is complex. For most investors, exposure through gold and equity holdings in commodity-producing companies is sufficient. The key is ensuring your portfolio includes assets that benefit during inflationary periods and avoids those eroded by inflation. Wealth building is as much about avoiding losses as it is about maximizing gains. Large losses require disproportionately larger gains to recover. Professional investors prioritize avoiding catastrophic losses over chasing spectacular gains. Risk management includes understanding risk tolerance and capacity, avoiding concentration risk, planning liquidity, and building a margin of safety. These principles protect your wealth and ensure long-term success. Stage 3 transforms your perspective from product-level thinking to portfolio-level strategy. The 8 pillars of strategic wealth building include asset allocation, diversification, behavioral discipline, market cycle literacy, instrument awareness, real return focus, risk management, and a long-term mindset. You now think like a strategic investor, ready to build and protect wealth. Stage 4 will guide you to financial independence, bringing together everything you've learned for lasting success.